Okay, we should be live. Hello, friends. Give me a sound check in the chat if you can hear my silky smooth voice. Once I get a confirmation that we're live, we'll do the intros and we'll start doing this thing. Hello, everyone. Oh, yeah. There we go. Sound is good. Let us introduce ourselves. Hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. We're live on YouTube. It's Thursday, October 5th, 2023. I'm a little under the weather. My voice might come in and out a little bit. I might have to clear my throat now and then because I live in Central Texas and it is a certain allergy season that kicks my butt every single time. And so I get a lot of congestion. My throat kind of gets stopped up. I got to drink a lot of water. And I try to avoid the outdoors for a couple of weeks. But we got some rain today. Maybe that'll help clear it up a little bit, knock some of that pollen out of the air, and my voice will get back to normal. So anyway, good to see everyone. So, yeah, it's been an interesting few days in the market, hasn't it? Since the last time we talked. Equities have been kind of selling off, but Bitcoin hasn't really done much of anything. So we'll look at the price chart for BTC here. We'll bounce around at the market, look at a few different things. We'll talk about some of the recession data that I have. And what I'll try to do today is actually keep this stream to an hour. In the past, they've been an hour and a half, 2 hours. And so just to get in a better habit of being a little more timely, we're going to try to condense this one down and try to keep it to about an hour. So that's the plan for today. I've got a few things that we'll just kind of look at together. I don't have a big overarching kind of narrative I want to talk about today. I just want to look through the charts together. I've been a little under the weather, so I haven't been sitting at my computer quite as much as I normally do. So we might see some things together for the first time today, and we'll just, play it loose and see how it goes. But, the things that I think are of utmost importance to talk about are long-end Treasury yields and equities. That's where most of the action has been for the last couple weeks, and those two things are intrinsically related to each other. When we talked last time in the previous stream, we were going over the FOMC that the Fed had in September 20th and 21st. And during that time, they gave us a new updated set of quarterly projections, right, for their SEP. That was this table that we were looking at together. And the thing that we noted here that is key in what is going on with prices were these two areas of the chart related to their federal fund rate projections, right? What they showed was based on the changes from June to September. They anticipated fewer cuts over the next 2 years. 50 to 75 basis points, fewer cuts, kind of depending on the way you're looking at it. But regardless, they pushed cuts out, right? Theoretical cuts were removed from the next couple of years of the terminal rate projections. And so what that's done has forced the market to reckon with the fact that yields, according to the Fed, are not going to be coming down anytime soon. We also have strong GDP growth. The economy is still going forward. So generally speaking, the long end of the curve has been kind of lagging behind Fed policy and what the economy is showing us for a long period of this saga. And they're just now beginning to catch up. We're getting an old-fashioned bear steepener. So if we go back over here and we look at like the 10-year, this is what it has done since, where was FOMC? FOMC was right here, right? FOMC was September 20th and 21st. That was right here. That was right at the breakout of the 10-year, right? And since then it has gone straight up. And during that same time, equities has gone straight down. Those two things are inherently related to each other. They're are a lot of people on Twitter that are trying to come up with all kinds of excuses for why this is happening. China is dumping all their treasuries. They're not. I can show you that here in a second. They're not dumping everything that they have. But the real reason why equities have been falling generally is because of yields. And I don't know where the high is on this. No one can really say. But we're back up in pre-GFC territory on long-end treasury yields on the 10 and the 30. They're both up here flirting with like mid-2007 levels. So not only have we erased the entire QE zero interest rate regime worth of yields, we've also gone all the way back to before the previous financial crisis. There's still a lot of folks that seem to not be willing to accept the fact that we're probably in a regime shift, a long-term regime shift in interest rates. The last 40 years have been in one direction. Interest rates have gone in one direction. Every time we've had a crisis of some kind, the Fed has lowered the terminal rates below where they were before. We'll look at this. You can see this even better on Fed funds. This has been the path of interest rates since I was born, basically. I was born in the early 80s. I was born around here. And in my entire lifetime, every time we've had a crisis, interest rates have set a lower low and a lower high in each subsequent business cycle in my lifetime. But we've now reached the bottom, right? The only direction from here is for rates to either go higher or to go sideways in a more volatile fashion. But we still have a lot of people in the market operating under a bias of rates falling kind of perpetually. But we've reached the floor. This is the zero bound, right? There's no direction lower than this. And what I think we're going through now, last year, and probably for the next year or two, is finding out what this new regime looks like, this new monetary regime. Because I don't think we're going back to zero interest rates in QE like we had in the 2010 to 2020 era, outside of some kind of crazy depression-like scenario. Right? That would be the thing that would cause them to just take us right back to the old policy. Because the old policy has led us to these problems, right? It led us to massive asset bubbles and dislocations. It has exacerbated inequality within the country. It has led to a relatively dysfunctional treasury market. All of those things are a result of this policy right here that went on for way too long, for this period of time right here. And we're now breaking out of this, right? We're setting a new higher high structurally on interest rates after hitting the lower bound. And what I think we're going through is a change in that regime. Now, it doesn't necessarily mean that we're going to turn right around and interest rates are just going to go up from here. Like we're just going to have like one of these, the opposite of this. That's not what I think. But I do think that it's very plausible that over the next few years, rates can look more like this, relatively speaking. They're not just going to go back down to zero like we had before. And they're not just going to keep going higher because of the amount of debt that we have and because real rates of growth likely don't support that kind of rate environment. But I do think the regime is shifting. And that has implications for asset performance, for people's portfolio allocations, for everything. And so that transition period is very volatile for an economy and for markets that have been used to this for, 13 years, 12, 13 years. This was a long time, from 2010 to 2022. So that's what I think. I think we're going through a regime shift. On a smaller time frame. It's why the Dow Jones has been falling while interest rates have been breaking into new highs. That's why it's been going on the last few days. But just generally speaking, the last few months, and I think going into next year, we're going to continue to be in this process where we're finding out what the new rate environment looks like. Because I don't think we can go back to QE. Because otherwise, the Fed just continues to crowd out public demand for treasuries, and that market needs to remain liquid and functional for the US government to operate in a healthy way. And so it's in their interest, the Fed and the Treasury together, it's in their interest to make sure that the Treasury market is liquid and functional and that there is a healthy aspect of demand. And I think that Powell understands that, and in a way, and as much as he is able to without a crisis forcing his hand, I think he's trying to shift us toward an environment that is less like the one that we just came out of from 2010 to 2020. A lot of people might disagree with that and say, you know, there's 33 trillion in debt. There's no way that we can have interest rates very high for very long at all. And that could be true at a certain point in time in the future. And that point in time could be drawn forward very quickly if we continue to have the fiscal problems that we have, if we continue to have the deficit problems that we have. We're basically running wartime deficits in peacetime. There are no other times in U.S. history where we've run deficits this large with unemployment where it is and not had some kind of a crisis that was tied to it, you know? And, that can pull forward the event horizon for when the Fed just has to straight up monetize the debt because we can't stop spending. But I don't think that that's immediately upon us. And there is still a demand for collateral, for quote unquote safe collateral relative to the system. And the U.S. Treasury for a lot of entities is that. So I think that we're going through a phase shift. And if that's true, and if interest rates are not going to look the same for the next few years, they're not going to behave in the same way they did for the last 40 over the next 10, right? If the response to crisis will necessarily be different because of the excesses that we did in 2020 that necessarily limit what we can do going forward. If any of that is true and the next 10 years look functionally different from the last 30 in terms of what rates do in a crisis, then that has implications for what assets will do. And I think that when you go through one of these kinds of periods, I mean, this was a 40-year bull market in bonds, and it came after a 40-year bear market in bonds, right? That's something that took up someone's entire lifetime in the financial markets where there was one trend, right? Let's go look at this on a bigger picture. This is that chart. This is the Fed funds rate. This is short-term interest rates since 1920, right here, right? Just after World War I. Here's the Great Depression. Here's World War II, right? Here's Paul Volcker. And here's us. Here's ZERP. What do you notice? There was a 40-year bear market in bonds, right? The low of yields was like 1941, right here, January. And then from there, they climbed to 1981, 40 years. And then what happened? They fell till 2021, another 40 years. This is a 40-year bear market and a 40-year bull market. Now, I'm not saying we're about to have another 40-year bear market in bonds just like this, but I am saying that the tide has shifted. It has noticeably turned. We've set a higher high. We will probably set a higher low if we do anything except go back to zero rates. Just think about it from a market structure perspective. If we do anything except go back to zero interest rates, we have shifted the trend on interest rates. It is different. And every business that was born in a zero interest rate environment or that needs it to thrive, every investment strategy that was successful during this period of time will necessarily have to change. And that can take a long time for people to understand, to recognize that it's happening, and to then figure out how to adjust. Because most people that have been investing during this period of time don't have any experience with this kind of environment, or just something fundamentally different from this. That's kind of what I've been thinking about lately, talking to some of my friends. It feels like we're at a major inflection point, and that the folks who, this is my view, it feels like the folks who will struggle are those who are late to recognize that they are in a regime shift. Those who are still preparing for the next 10 to 15 years to look like the previous 15 years, those people are setting themselves up to be wrong-footed. And then to extrapolate that further, people who have thrived in the last 35 years of markets, which have been a period where U.S. stocks during our lifetimes, my lifetime, has been the greatest performing asset class of any asset class in the history of human markets. And it's been because of this structural falling rate environment and a massive deflationary supply of labor that came from China and Eastern Europe joining the global economy, right? The dissolution of the Soviet Union, the fall of the Berlin Wall, the entering of China into the World Trade Organization, those things all happened from 1990 to 2001, 1989 to 2001. Those things were a one-time massive labor dividend to the global economy that we're not about to get again right now. They also came during falling interest rates. So with all those dynamics shifting, you have to start thinking tectonically about what that means for the market big picture and how things will begin to maybe be different than they have from the past. Perhaps certain asset classes will not clearly outperform as they have, right? Maybe U.S. tech doesn't have the same Goldilocks 2 decades that it just enjoyed, right? I don't know, friends, but these are things that we have to ask ourselves if we're going to participate in the markets. You have to recognize when you're in a phase shift, when you're at an inflection point, and those can take years to manifest, right? You don't just have an inflection point in a single quarter on the calendar. It doesn't just happen in a given month because of an employment print or something. It takes place over a few years, right? It takes place over an administration or two. And if you believe that we're in one of those now, then as I do, I think it's really fascinating. But it also means that, asset performance and the correlations to them and the relationships between asset classes might be a little different. Maybe U.S. tech isn't the safe haven for the next 10 years as it was for the last 20. I don't know. But volatility breeds opportunity as well. Because, most people are accustomed to the stock market just going straight up, right? Well, let's go look at the S&P real quick. Let's look at the S&P. Let's put it on a candle chart. Daily. We'll just do weekly. There we go. There are long periods of time where the market just goes nowhere, right? But it doesn't mean there isn't opportunity. Look at that. That's a 12-year period. In the 2000s, it was in this century where the market went nowhere. At the bottom of the great financial crisis, it erased a 12-year market, right? It touched lows that hadn't been seen in 12 years. 2008 or 2009 right here, all the way back to 1996, 97. And it erased a decade of price action. We had the same thing happen in the 70s, right? Go back here. Look, this was the 70s. The market went essentially nowhere until the middle 80s, when it finally broke out of this long-term consolidation that it had been in since, I guess, really about 1968 right here. So that's essentially a lost decade in the markets. There was plenty of opportunity. There was a lot of volatility. The world was going through a period of change. Demographically, geopolitically, we had a couple of energy shocks. We had the boomer generation exploding. There was just a lot of fundamental change. Nixon closed the gold window right around in here, August 1971, right around where my cursor is. Nixon closed gold convertibility on the US dollar. Exchange rates started floating around between different currencies. Global FX trading became a thing a few years later. The world went through massive changes during this period of time, and the markets were really volatile and choppy. this was also a big period of change. It came at the end of one of the greatest asset bubbles in world history of the last 150 years, certainly, which was the Japanese real estate market, right? That peaked right here in 1990, and then it carried forth into the rest of Asia. That we had multiple crises through other Asian countries through the rest of the 90s and the 2000s, and that capital rotated into U.S. stocks. We had this massive bubble in tech stocks in 2000. This is the NASDAQ, right? Well, during that period, other stocks also appreciated, but then they just kind of went sideways while we had this big deflation in tech stocks. And on the S&P and on the Dow Jones, it just kind of looked like a lost decade. You know, we've now had a massive appreciation from the bottom of the great financial crisis. And in this period of time, we introduced zero interest rates, right? Let's throw that on here. During this period of time, while the markets ripped, this was the period of zero interest rates. And so if what we're theorizing has any accuracy to it at all, we've now set a new high above this level. Just think about it structurally for an economy, right? If they cut rates in the next crisis, doesn't matter where it is, doesn't matter if the Fed funds go sideways for a while, doesn't matter if they start cutting tomorrow, for the purposes of this exercise, if Jay Powell does anything except take us back to zero, well, that is a higher high and a higher low at the end of a 40-year downturn in rates that ended at the zero bound, which came after a 40-year uptrend in yields that began at the zero bound 80 years ago. So you see, it kind of all comes together in a big cyclical fashion. So if we're actually going to go through a tumultuous period where, at least for a period of time, rates are more volatile because we have more inflation, we have global arrangements shifting around, right? Manufacturing is moving to different places. Demographics are tectonically shifting in major economies, both in China and in the US. Then there's going to be a lot more volatility in the markets, in interest rates, in the economy. During the 70s, during the 2000s, during this period, we had 2 recessions. Right? If you go back to the 70s, we had 3, 70, 74, 75, and then at the end, 79, 80. We had 3 recessions during that period. There was also one in the middle 60s, I think, 61, 62. So we might have a couple of recessions. We might have choppy markets. They've gone up, straight up, for 15 years, right? At some point, natural physics will take over. And the real question we have to ask ourselves now, if we're just thinking in a timely way, the question for us now is, are we now in a new downtrend, right? Or will the markets get one more last gasp higher before they then have to roll over and fall in whatever kind of recession we think is probably coming? And that's a real tough question to answer. Structurally on the Dow Jones, just from a TA perspective, kind of pulling back from this talk of cycles and regime shifts, just kind of looking at the chart. I was really hoping that the Dow would hold some support in this area right here. We had multiple weeks of consolidation. It would kind of maintain the ascending structure here, and we were right underneath the all-time highs, right? From this point, I think we were only about 5% away, 3.5%, 4% away. But we've broken down. And now we're getting a lot closer to this low here. And, if we get below that area, then I really don't think we're going to set a new high anytime soon. And we may hit a recession before we get the opportunity to find that out. Because we're really running up against some timing here, historical timing, that's close to when recessions are happening. Right? This is the period of time in terms of how long the yield curve has been inverted, how long the cyclical parts of the economy have been, underperforming, which they have been. We're in that sweet spot. And so if all of that is aligning, and if history does rhyme once again, and we have a recession sometime in the next few months, which it's very likely in the next 6 months or so, then that greatly diminishes the chances that the market gets another swing at the all-time high anytime soon. Because as we've explored, friends, together here many times, let me line this up here. Let me line this up with yield curve inversions. I'm sorry, recession start. Here we go. This is all prior recessions. This vertical line is when the recession began, and these black triangles are where the bottom of the market arrived in that cycle. Every one of them has been after the recession began, right? So with that knowledge, that's 100% hit rate since 1948. And so if you have that knowledge, then you have to think, okay, well, if we're getting close to a recession, then we probably will see a price that's lower than this price right here on the Dow Jones, lower than, what is this, 28.6. On the S&P, I believe that's about 3,600. Yeah, 3,600, 3,500. And so we're running out of opportunity for the market to get another swing at an all-time high if it doesn't begin to manifest soon, right? If the long end yields continue to push higher, as they have been, it will weigh on risk assets necessarily, because that's how it works. And so that's kind of what I'm thinking here. You know, I'm really watching this structure. If we start breaking below here, if the Dow's breaking below here over the next few weeks, then I'm starting to think that the odds of getting above this, let alone getting above here, are greatly diminished because of the risks of recession getting closer and closer. And so, this is a worrisome time in that regard. Now, it hasn't completely destroyed itself. It's below where I would have wanted it to go. I wanted it to hold up here, right? Just because that just looked like a logical place. But this is clearly the next low. So if it holds up above here, then, we can still get a bounce. We're still not structurally in Hades, right? It could be ugly, but then we have to start looking, okay, are we going to get a lower high? Are we going to get above here? If we do start to manifest a bounce, then we have to worry for the next few weeks until we get above these levels. And then we have to get above these levels. Then we can start feeling better. That's just a general take on the TA, because we're at a structural turning point right here. We've made what looks like a new lower low, at least on a short time frame here. If it goes below here, it will be a lower low. And then you have to start looking for the lower high. It looks similar over here on the S&P, right? We're kind of near some of these support levels. Here's one right here. We've already gotten below the August level. We've set a new low below here. If we take out this and we start trading below this pivot, that's pretty ugly, right? That starts greatly diminishing the odds of getting above here before the recession. So this is the kind of place where if you're a bull, at least a near-term bull, if you're one of those kind of folks who's really excited for the end of the year because you think that risk assets will do well as they seasonally have, then you've really got to hope that the 10-year and the 30-year fucking stop doing this, right? They're just gone straight up since FOMC. And when you zoom out, like, they're getting close to maybe the highs. If we consider the GFC top of the range to be kind of the highs, they're close to that area, right? The 10-year is close. Where is it for the 30? Here it is for the 30-year. It's close to that area. The 2-year is already there, right? The 2-year is at that spot. And so that's why we've been getting the bear steepening. The front end hasn't really been moving very much. Long end yields are climbing. So for risk assets, especially for the Dow, for the S&P, for the NASDAQ, it all comes down to holding up some of this structure. The NASDAQ doesn't look quite as bad, but it also had a much bigger rip. It ripped 36% just since SVB collapsed in March. Right, this is an insane move on the NASDAQ. Look at that, 36%. That's insane. The S&P looking a little more sus. The Dow looking a little more sus. If you're a small cap company, good God, friends. The Russell 2000 looks so bad. We got people talking about a new bull market. There are 2,000 companies in the stock market that are saying, no, sir. No, this isn't a new bull market. We're actually below the 2023 open on the Russell 2000. We're also really close to it on the Dow Jones, actually. Where's the 2023 open? Oh my God. Look at that. Is that a red candle? Oh man. The Dow Jones has a red candle for 2023. Look at the NASDAQ's 2023 candle. You see that? It's up 34% year to date. The S&P is up 10.5%, though the candle has a big wick on it. The Dow Jones has a red 2023 candle. That's brutal. Russell 2000's down 1.5 points. So you've got major parts of the market that are not singing the same tune, you know. And if we look at the components of the Dow Jones, I was looking at this just before the stream. The components of the Dow Jones are not pretty. This is 2023 performance of the 30 stocks that are inside the Dow Jones. Some of these stocks are down 20%. Look at this. Walgreens stores are down 40%. 3M is down 29%. Verizon minus 21%. Nike minus 19%. Coca-Cola 15.5% negative. Travelers, Johnson & Johnson. This is a huge portion of the Dow Jones that is deeply underwater year to date. But we've got Salesforce up 48%. Intel up 34%. And Microsoft up 32%. This is the disparity in the market. Is it not? This showing it right here. A few tech companies, while everything else is really struggling just to breathe fresh air. That's not a healthy market. That's not how bull markets begin. These companies are telling you something is wrong. And on a rolling 12-month basis, this correlation here between the Russell and the S&P has completely broken down. Let me show you. I think I showed you guys this last time. This is the Russell 2000 rolling 12-month correlation to the S&P. It's broken down similarly to how it did at the beginning of 2022 when the market started selling off, right? This is, up at the top, the correlation between the S&P and the equal weighted index. This correlation's broken down to all-time lows for the last 20 years. That means that we have market cap leadership that has diverged completely from the equal weighted version of itself. That's very concerning for me personally, because I think that it's giving people the wrong idea about the strength of the market. They're looking at the S&P, which does matter to people, right? The S&P is what's in people's 401ks. It's the number that gets reported on the news. It's the one that's used in the end of the markets wrap articles that Bloomberg and Financial Times and the Wall Street Journal and everybody publish every day at 5 p.m. So that number matters. But when you look at every other part of the market, it is screaming something that doesn't seem good. That is unhealthy right there. And you can see that here. Dollar's still climbing, but I think maybe we're getting close to a place where it'll start to slow down in terms of momentum. You can see here, like this is kind of the area where I would have thought it would slow down, 107, 108. If it gets above here, then the next stop is 109.5. And, you know, if you're someone who likes diagonal trend lines, you can draw this expanding wedge here, and you can see we're kind of meeting some resistance near this zone, this supply zone, and this ascending wedge. So maybe the DXY slows down a little bit. This is like 12 straight weeks of green, which I don't believe it has anywhere else. Let me check on my consecutive candles indicator. There's one other time that it hit 12, and that was in 2014, right here. This movement on the DXY. This is the only other time ever that the DXY had this many weeks in a row where it was green in the middle of this huge move in 2014-15. Now, that doesn't mean we're about to do this huge move here. Don't make that kind of direct comparison. That's not what it means. But you can just see how rare it is to have this kind of streak, which greatly increases the odds that it is over, right? That the rip is over and it will consolidate. You know, maybe it does kind of one of these things. I've seen BC Backer draw that. He's more of an Elliott wave guy. I don't have Elliott wave skills in the sense where I can just, see wave counts the way he does. But, I've seen people draw in these kind of consolidation pattern. It just looks like a little flag. Maybe something like that happens down into this level. And that could give risk assets a boost, right? Maybe that chills them out a little bit. If that happens at the same time that 10-year yields maybe finally cool off, maybe for like a couple of weeks, they kind of do one of these back down here. Maybe then they go higher. I don't know. But if we get that at the same time that the DXY gives us that, then that will create room for equities to do one of these, right? To bounce. And then we have to wonder, are we going to set a higher high? That's the big questions for the stock market right now. Bitcoin, there's almost not much to say here, which is why I wasn't even really quick to jump over here. It's kind of the same place it was in 2 weeks ago. 2 weeks ago, we were right here, right? This is where we were talking. We've hopped up a little bit higher. We're now, around 28,000. That's good. We're continuing to set higher lows on the weekly chart. This was a higher low off of June. So that's great. I'd like to see that structure. I am bullish above this candle. If we get below this wick, I would be very concerned. If we got below this one, well, that's really nervous because it's only like $200 apart. But below this wick here in June, that's scary town. So, let's keep watching this. I was bullish here. I was bullish for BTC to at least get back up to this level. We tagged it, and then if it got over that, then the next level's up here somewhere. Forgive my sloppy lines. But that's looking pretty good, right? BTC's looking good. I think part of the reason why it's not eating shit while equities are eating shit is because there's just no one left in this market. There's been a lot of news on Twitter. People get really excited when Bitcoin doesn't correlate to a bad period of time in TradFi. And that's cool. Like, I'm glad Bitcoin isn't selling off, because then I'd be even more concerned about its, near-term future. But I think the main reason why it's not going anywhere is because this move is a TradFi-led move. Right? It is de-risking and portfolio rebalancing in TradFi by large entities as a direct result of long-dated yields going higher, of the re-rating of growth expectations. Like that's what I think it is. And Bitcoin, it had its brutal period, right? Most of the players who would be handling the market in that way have already exited Bitcoin in size. They're not here, guys. And so Bitcoin's not going to do very much, right? It's very low volume. We've got a couple of these little pumps. These were led by open interest in futures. Both of them were. This move back here on the day when we got that grayscale news and everyone got really excited about the ETF, there was a short squeeze here in futures. A bunch of positioning got crushed. And then, price just came right back down. This same thing happened over here. This was an open interest led move, like $300 million or something of positioning just got eliminated. And then price came all the way back down to that level. So people get really excited about these moves, but you just really need to keep in context the health and the depth of the market right now. It's just not in a great place. This is a lot of speculation that's chopping around, in a volatile way. It doesn't really mean anything, but it doesn't stop people, doesn't stop accounts on Twitter from making grand proclamations whenever we have a day like this. I saw some account, I'm not going to name them because I'm not trying to be like that about it, but there's a few accounts that I saw, big accounts, that made tweets, oh, look, everyone's suddenly, Bitcoin's breaking away from traditional markets. It's getting that safety bid the way that it did in March after the bank collapse. And, everyone's waking up to sound money. And it's just, Total bullshit, guys. Look, I'm a Bitcoiner. I own quite a bit of Bitcoin. I spend a lot of time studying it and learning about it and thinking about it. I am bullish on its role in the financial system in my lifetime. But I'm also a grown-ass adult, and some of the things people say about the way the market is working or is supposed to work, or the way price action is supposed to behave, are absolute childish fantasies. And I dismiss them outright. It doesn't make me bearish. People ask me this stuff all the time. Do you just not like Bitcoin anymore? Like, no, I love BTC. I think it's fascinating. I think it has a really interesting place in, the greater scheme of things, particularly over the next couple of decades as we go through what I believe will be some major turning points in financial markets. But that doesn't mean that the number should just go up all the time. That doesn't mean that people will stop behaving in the ways that they always have with their money, stupidly. None of those things will change. Human nature will not change just because there's a new kind of money out there. And that's my message to people all the time. And so when I see crazy proclamations about price, when you can just go to CoinGlass or Levitas or Velodata, any of these sites, and see that this was a futures move. Some dudes got just liquidated here and it came right back down. Just be an adult. Just be a fucking grown-up and quit needing these fairy tale stories about Bitcoin to be true for you to feel good. That's not the way the world works. When that happens, when there is a day that millions of people change their mind about a currency, you will fucking know it. It won't be some $1,000 move on like a Sunday afternoon. Okay? That's not what it's going to look like. We won't be debating it. I'm not saying that's going to happen, but if it ever did, it would not be these little piddly jerk-off moves. I know I sound like I'm getting really vulgar and fired up. I'm just a passionate person, but I see this stuff all the time, and I get in these conversations with people where I feel like I have to teach children how markets work, and it happens a lot in the Bitcoin space, and there's going to be that going forward. There will always be these people that I have these conversations with where I'm like, that's not how the market works, bro. It's always going to be the case. And I might always sound mad about it. I'm not. But I like being able to share information with people. I like sharing accurate information with people. And I like putting my finger on the pulse of what's actually happening and not just making up a story for engagement. Part of the reason why, I don't get a lot of invites to like big Bitcoiner events and get sponsors from Bitcoin only companies, because I don't suck BTC's dick all day long. I have my own views. I'm quite bearish sometimes. I tell other Bitcoiners that they have stupid opinions a lot of the time. And it sometimes doesn't engender me very well to, certain social groups within this, asset class, which it's weird that it has social groups in the first place. But Bitcoin is a risk asset. If we have a recession, it is going to sell off. It's going to sell off in dramatic fashion. It will probably break these lows and continue going lower, commensurate with the severity and length of that recession. Whenever we get to the end of the downturn and the virtuous cycle can begin, Bitcoin will be one of the first assets to respond to that shifting dynamic. And that's where it's really valuable to pay attention to. But to expect it to behave differently from the way every other financial asset behaves is just fundamentally ignorant, I think. Ignorant. So I've been ranting for a little while. I'm going to look through the chat and make sure I didn't miss any questions or anything. I love you guys for hanging out. We've got 200 viewers. How many likes do we have on our vid here? It's blocking it on my screen. Got 119 likes and 230 viewers. Guys, I'm working my ass off here. I look at this charts all day. I study all this data to bring it to you. All I need is for you to click a button with a thumb on it. Show me some support. Give me the thumbs up. Subscribe to my channel. That's all you got to do. All right? Do I see any positive indications for the crypto market? So I see positive indications so long as Bitcoin doesn't set a lower low, because it will lead. And I believe it will be able to do that as long as we don't hit a recession anytime soon. If the labor market continues to hold up and the worst case scenario doesn't manifest, maybe it doesn't happen at all, or it takes longer than people think, yields will eventually cool off, right? It is physics. Markets don't go in one direction forever. The perfect example is oil, right? When oil was right here at $90, what happened? Stories came out saying oil was going to $100. It was going to $110. But if you just drew some lines of resistance on your chart, you would see that it was running into resistance and everyone was getting bullish. And now what has happened? Oil, in despite of insanely bullish supply dynamics, right? There's not enough oil. We've drained the SPR, blah, 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 blah. Oil's down 13% in just a few days. And so the market can go wherever it wants to go, and the yields will have the same thing happen. They will run into a period where, just from the pure nature of physics, they will cool off. And if that happens soon, before equities completely lose their structure, right, and get down, the Dow Jones gets down below here and starts dancing around. If we can have that happen, then everything can maybe continue to climb into the end of the year. It is a seasonally strong time of year for equities. Seasonality isn't everything, but it is something. And the last few months of the year are pretty decent, typically for Bitcoin and for equities. And so if we can get that, and maybe the recession doesn't become obvious until Q1 of next year, then that can be good for crypto, right? But crypto is kind of tied to what's going on with liquidity and risk appetite broadly. The space has gone through its own version of the great financial crisis. That's what last year was. We rinsed out every Ponzi. A bunch of businesses went under. A bunch of lenders were disgraced. We had SBF, the biggest Ponzi scheme of all. So this was crypto's great financial crisis, and no one's here. But because there's a belief in 4-year cycles, and because of the violent negativity of last year kind of being at an oversold point, the market is manifesting the beginning of the next bull market for itself. And that's what's really important to understand about markets, generally speaking, is that they don't just move into completely new areas and stay there without being given a reason to. They don't behave differently from the way they have in the past unless they're given new information. And so even though I believe a recession is coming because of the data I look at, the crypto market, as far as it is concerned, has completed its bear market drawdown, and it is now in that slow build-up phase into the next bull market, right? We got the halving next year. Everyone's looking out towards that. If you just only follow people in CT, all of them are talking about where they think price is going to go between now and the halving, what it's going to do after the halving. Everyone's getting their bull market ideas prepared. People are shopping altcoins to buy them for the next, 10x. Everyone's just assuming that the cycle has continued on. And if you look from an on-chain perspective, Bitcoin looks that way, right? A bunch of on-chain metrics look like they bottomed during this period of time right here from June to November of last year. So price is setting higher lows. On-chain metrics are setting higher lows. Activity's picking up a little bit. Here, I'll pull up a Glassnode chart here real quick, and I'll show you guys a couple of things. And so, until it is interrupted with new information in the form of some kind of a crisis or a full-blown recession, until that happens, the market is going to move forward the best it can. And I think that that's kind of a soft pitch, bullish idea for crypto, but it sucks because it doesn't really get to decide on its own. All right, like AVAX and Ethereum and Solana and fucking Optimum and like all these altcoins, they don't get to decide on their own if crypto gets to have the next bull market. They need to be supported by the economic environment, by the liquidity environment, as they have been in the prior bull runs. Right now, they're not being supported in that way, but they're still trying to move forward, right? They're still trying to like eke towards what the next bull run eventually looks like, thinking that it's coming. I am just contending that it's likely something will interrupt that process before it really finally gets to climax, because we're getting to that crunch time for the recession. Let's look at some Glassnode stuff together for a little bit here. It's been a long time since we looked at these charts together, but I'll show you a couple things. So one of the things that I like to look at a lot is active entities. Here it is. I like to look at active entities. It's just general network activity. And one thing that's been really positive is that, broadly speaking, Bitcoin's been able to set higher lows on this chart. You see this? And this low right here was in March. So we've continued to set higher lows. This is unique entities interacting on the ledger each day. So keep in mind that we're now talking about Bitcoin on-chain. This is not the liquid market. This is not literally buyers and sellers. This is the ledger. This is people moving around BTC on-chain, different UTXOs moving around. And so active entities on-chain, it sets these highs in the bull market and then it falls down as activity, dies on-chain early in the bear market. But since the middle of the 2016-17 bull, we've been continually setting higher highs, right, in this kind of structural way, and we maintained that structure here. This low is above the low from the 2021 bear market, the one from March, and we've continued to kind of grind higher. This chart is saying, hey, yeah, bull market's back on, baby. We're in the slow accumulation phase. If you go look at the MVRV ratio, what did it do? It fully bottomed in the same place that it bottomed in all the prior bear markets. The low was here December and January, and then it shot back up, right? Cycles continuing on. Everything's great. Dormancy flow. Entity adjusted dormancy flow. Here's another one. This is the ratio of age-weighted activity on chain versus the market cap. It's a ratio of those two things. When it's elevated, then the market cap is rising commensurate with activity on chain. That's like a healthy bull dynamic. That's what happens in bull markets, right? It rises, then it falls in the bear market. We set new lows on this metric. We bottomed in ways we've never bottomed since the beginning of price on entity adjusted dormancy flow. But what happened? End of December, early January, when price also picked up, this metric bottomed and it shot back out, right? There's another view of it. Let's go look over at hodlers real quick. What had happened with the hodlers? Well, long-term holder supply just continues to climb. The same dynamic that we get in every bull run, in every bear market. I know I'm hopping around here a lot, guys. Just there's, someone asked a question about on-chain. I wanted to show you. So we had the big sell-off of hodlers. This is the falling of long-term holder supply in the bull run. These are people who waited in the bear market who are paying themselves as price is breaking into new highs. That's what happens in every bull market. And then what happened in the bear? We have now seen accumulation. The hodlers on net have stopped spending, and this metric just continues to climb higher. That's the dynamic in every bear market. And I could just go down the row. I could show you 20 other charts that all corroborate this view. And they're just corroborating the idea that we had the bear market, the worst is over, we're now looking forward. And that will be true until recession interrupts that. And I think we're getting close. David Miranda, thank you so much for the super chat. Very generous, brother. Can I go into how Bitcoin might behave in the recession compared to past speculative bubbles like the dot-com bubble? Well, I kind of started to show that before, like this is the S&P in recessions, right? Here's the beginning of the recession, this vertical dotted line. The low is after the recession begins, anywhere from 2 months to a year and change later. So I think that it's important to remember that Bitcoin is treated like a risk asset. It has thrived in environments supportive of risk in the past, and it has not done well in environments that were antagonistic to risk. And so when you go into a recession, which we have not seen since 2009 and 2008, COVID doesn't really count, then you have to kind of bucket, because we don't have that information, you have to bucket Bitcoin with other risk assets. And in a recession, they do not perform well. In the beginning, they are sold because they are long duration and they are high risk. But what you could then think about is, okay, but Bitcoin also, it has this outside money property, right? It's not just a risk asset. It's also a monetary asset that exists outside the TradFi, ecosystem. It's its own thing. And so you can go, okay, well, maybe it will do something similar to gold. And so, okay, let's look at gold then. Let's look at gold and let's also look at the S&P at the same time. And what you see is that gold did sell off during the Great Recession. It sold off from March 2008 to October 2008. It fell about, I think it was 33%. Yeah, 34%, call it. But it bottomed 5 months before the stock market. And it began climbing as we got to the depths, the worst parts of the downturn. This was when we had some of the biggest response out of the Fed, right? Because Lehman went down in September, right around this period right here is when Lehman Brothers went down. And the market sold off hard. And then the Fed really stepped it up. And so that's when we got a lot of the money printing. A lot of the Fed backstopping of what would have been a depression. And gold began to climb during that period. So I think that that's the way to look at it, is in the initial fall of the recession, it's most likely that Bitcoin will perform like risk and like gold, and it would fall. I believe it would set new lows and it would break below the lows of last year. I don't know how deep it would go. That would depend on the severity of the downturn. It does not depend on how quick the Fed pivots, because they could pivot early on, but if they've done enough damage, it might not matter for a few more months, because the economy is more of a slow-moving object. And as we've shown on here before, if you look at Fed funds, this is the federal funds rate. The Fed began cutting in September of 2007, back here. The market fell the whole time the Fed was cutting rates. They finally ended their cuts December 2008. The market bottomed March 2009. This is more typical of what happens. So it's not about the Fed cut. A lot of people focus on the Fed cut. I don't think that that's going to be the moment that everything turns around. That might be the moment that yields start falling, that just makes sense, but that doesn't necessarily mean that's the moment to go all in on risk, or that's the moment that BTC bounces or anything like that. That really depends on how much damage has been done that's causing them to cut in the first place. So I think initially it sells off, and then as we get near the end of the bad stuff, as the deleveraging happens, as businesses go under, people lose their jobs, whatever that looks like, that's what a recession looks like. Once we get near the end, I think BTC would rally first. If the U.S. government, for some reason, were to make a cash airdrop again, will we see a new all-time high? I mean, yeah, probably. We probably would. But I don't think that we should want that at all, because we would also see double-digit inflation. We would see double-digit inflation. And we would probably then see double-digit 10-year yields. And that would probably destroy the financial system. Because it's the benchmark rate for all things. The US 10-year is the benchmark rate for tens of trillions of dollars of other markets. Do I agree with BCB or have my own theory? So blockchain backer, I don't know which theory you're talking about, but he and I do tend to agree on a lot of things. He and I look at different data though. And so, he has an Elliott wave perspective. He's really good with market fractals, and he is primarily a chartist. I do look at the charts, but my strength is in data analysis. And so I look at a lot of economic data. I look at business cycles. I look at, various different components of the economy and how they performed at different times. And we both come to really similar conclusions about what's ahead. And I think that we're about to go through a really bad recession. I could be wrong, but I don't think I am. I think the odds of me being wrong are probably in the single digits. What number are you going to be adding to your Bitcoin stack? I already added to my Bitcoin stack. I bought Bitcoin last year, a lot of it, relative to me. I'm not buying it here. That's not how I work. I was doing a DCA, but I stopped doing a DCA just because I didn't really like what it was doing to my cost basis. And so I don't actually have one of those, but I decided instead to just make a lump sum allocation over a period of a couple of months. And I was lucky enough that it has so far been the low. I bought in September, October, November, December, not knowing where the low was. But I just showed you all those on-chain metrics, right? That's why I was buying. It's because MVRV had bottomed. Everything looked like the low of the market. We were below the realized price. We were below the 200-week moving average. But I had no idea. Everything was actually quite bearish. And I was afraid that things were just going to keep going down. But I still bought some BTC, and I was, with a short stop. If it goes below 15.5, I'm getting out. But that's not what happened. So I'm not looking for a price to add to my stack here. And if we go into a recession, I'm not buying Bitcoin throughout the recession. I'll wait till later on. I'll probably want to look at some other data points and model what I think the recovery probably looks like. I will be paying a lot of attention to gold and, yields. And if those things are favorable, then maybe that's a good time to start allocating. But that's way ahead of where I am now. It's not something I'm going to try to game plan right now. With all these you're believing in, why don't you cash out everything you got? Because I could be wrong, Mahi. It's risk management. Just because you have a thesis doesn't mean that you go all in on that idea today. And that goes in both directions, guys. Like, just because I think Bitcoin will be worth significantly more money 10 years from now doesn't mean I buy a fuckload of it today and then just close my eyes and let whatever happens happen. Some people will do that. And if that's what they choose to do, that's wonderful. Do that. That's great for you. I'm not going to do that. All right. I have a family. We have retirement accounts. I own real assets. I own a home. I have a child. I have income. I'm not just going to throw everything in digital corn at some massive allocation of my net worth and then just close my eyes and wake up in 2030 and see what happened. Just because I think we're going to have a recession doesn't mean that I sell all my risk assets. Now, you have to have plans for yourself. You have to set boundaries around the market you're participating in, right? That's the way that you got to do it. For everyone, it is a different thing. But if this is the market that you're in, and you have no idea what's going to happen, and you got in right here, maybe you decide for yourself, well, I don't want to take a huge loss on this. So if price goes below, I'm just making stuff up, guys. This is just what I'm trying to get across to you. Maybe you have a plan. Well, if it goes below there, I'm just going to sell it. Or maybe if it just goes below where I got in, I will sell. And if it goes back above it, I'll buy back in. Or maybe if you're really worried, you just de-risk a little bit. There's something called the sleeping point. And every market participant should reduce their level of exposure down to the sleeping point. And that means that if you can't sleep at night, you have too much on the table. And so I manage those emotions. I manage my assumptions about the future by not going super ham by buying Bitcoin here, because I don't think that it's a good risk-reward bet. And I'm willing to be wrong about that. It's fine. But the point I'm trying to get across is just, it's not just, okay, well, I've got this grand thesis, so I'm going to position everything I have towards that long-term outcome, and then whatever happens in between is just noise, and I'm just going to say that I'm convicted. I mean, if that's how you want to roll, then, by all means, do that. But that's not how I roll. So I have rules for myself. If price goes below the lows of last year, I'm not going to just sit there and eat shit. I will have de-risked before then. I already have taken some of my profit from some of my equity holdings and things like that. If BTC were to be much higher than this, I would sell some of my Bitcoin, frankly. That's how I'm going to manage some of this. I'll tell you right now, if BTC gets up into the retracements, let's look at the monthly chart. If Bitcoin gets up into this range, anywhere in here, I'm selling something. I'm not selling all of it. I'm not going back down to zero. But I'm going to sell a bunch. I'm going to pay myself because I have a bunch from down here. It will have more than 100x'd. And let me add this level of detail. If Bitcoin gets up here and nothing about the economy has changed, nothing about my belief about the recession has changed, and in fact, if it's anything like it is today or worse, I'm absolutely going to sell. Going to sell some amount of it, probably more than half of it. And that's my choice, right? Because I want to pay myself for the amount of risk I'm taking in the market. And I do not subscribe to the idea that there is some miraculous future where I can't buy Bitcoin because no one will sell it to me. That scares people out of profiting from their market exposure. And that is an immature way to look at the market. That isn't how it works. Higher prices will always unlock supply. And, you can keep some exposure while paying yourself with another portion. And I'm not just talking about BTC. BTC is not the only thing I own. That's just what's on the screen here. I have stocks. I have a couple of Ethereum. I have a little bit of XRP. I have a 401k that's got index funds in it. I have a bunch of assets. I have some gold. I have some silver. I've got some other collectibles that are worth money. Like, when I say pay myself, it could be any percentage of all of those things, because all of those things make up my net worth. So you just need to think about this stuff for yourself. Think about prioritize what you're willing to liquidate and not liquidate. Because every asset you hold, there is some willingness on your part to make a market for that asset, meaning sell that asset. There is a price for almost everything you own that you would be willing to sell it. Some of those prices are insane and they'll never get reached. Some of those prices are pretty close to where they are today. And you just need to go through that thought process. Okay, what do I own? How invested am I in this thing? And in actual dollars, what do I think it's worth? If it gets to these certain, what's a price where I'd be willing to sell? What's a price I don't want to see it at? What's a price that I would buy more at? Think about that stuff. I'm not going to give you my specific rules because they're specific to me. And I don't want to just hand you the answer. I want you to think about it for yourself. Because I'm not a financial planner. I am just a dude on the internet. I used to be a bartender. Don't listen to me for financial advice. Just consider what I'm saying and apply it to your situation, okay? That's all that you can do. The sailor pitch that you won't be able to buy Bitcoin again. It is the sailor pitch. And I'm telling you, it is bullshit. It's absolute bullshit. If we have an asset where no one is willing to sell it, then we don't have a market for that asset. Every buyer has a seller, right? And look at this chart of long-term holder supply. What does it do when price goes up? It falls. Why is long-term holder supply falling? Because that supply is becoming short-term holder supply. It is being spent. Its lifespan is being reset to zero, and it is starting over as a new young coin that is owned by someone else. That happens when prices go higher. New prices will unlock supply because they will drive market participants to act. That is how the market works. That is how bull runs happen. Distribution is a fundamental component to the bull market. So when prices go up, you better believe someone's going to be selling. I am. A bunch of other people are. There will not be a future scenario where you're trying to buy Bitcoin and literally no one will sell it to you. There's always going to be a price. If there isn't a price, it's in real trouble because that means no one wants to make a market for it. And if it doesn't have a market, it doesn't have a value. It's only worth what someone is willing to take for it. Right? That's true for currencies. That's true for the dollar. It is worth, relative to all other things, what people are willing to give for it. It's an exchange rate. Bitcoin has an exchange rate versus all other assets. And as that exchange rate becomes more favorable, people will offload their BTC. So I am not afraid to sell some if price goes higher. If it gets up into the retracements, the economy still looks as bad as it does today. Oh, and I still believe that a recession is highly likely. I will. If this happens, it also probably means equities are at all-time highs. Because for Bitcoin to break out, it probably means the Dow Jones broke out, right? So everything has been going higher. And so if everything is going higher and the economy still looks really fucking sus, and I think we're going to have a recession, then my mind frame goes to, this is a blow off top, and I'm going to sell. My takes are too rigid. My takes are anything but rigid. I don't come in here with any dogmatic, this is what's going to happen. I spent the first 20 minutes of this stream talking about maybe we're in a regime shift. If we are, this is maybe the way to think about it. That's not rigidity, friend. I don't know enough to be rigid in my views. I'm a caveman, right? I don't know enough. The recession does look pretty likely. We haven't gotten a ton of new data in on some of our modeling. But as we've noted in the past, wage growth has come all the way back down to the pre-COVID average. And so what we're really hoping for is that the labor market holds up. Not wage growth. I said wage growth. This is job growth. Excuse me. This is the growth of non-farm payrolls. And it's come down to the pre-COVID average. And so we really need to hope that there isn't continually higher unemployment, because that would suggest that we're getting, into the danger spot. And, if we look at other parts of the labor market, these are three other components of the labor market. At the top, we have temporary workers, and it's inverted. It normally looks like this. This is the number of people employed in temporary work, seasonal workers. You can see how it falls going into a recession. Let's just reverse it. This one here is it says losers. These are job losers. These are people who answered on the employment survey, I was fired from my job. And these, rather than job leavers, people who chose to leave. And then down at the bottom, these are the unemployed. This is the numerator of the unemployment rate, which is this over the labor force. What do you see over here? If we just look at the rates of change of the number of employed people, the number of people who said they were fired, and the rate of change of temporary workers inverted, you see them, they're all breaking above the middle zero line, right? And then if I draw some horizontal lines here and we just kind of see where we are in history, let's just draw some lines on here. Here and here. Okay. What you'll notice, and feel free to pause this and look at it for a minute. I'm going to leave it on my screen here. Where these black lines I just drew is where we currently are at these levels on all of these metrics. These gray vertical bars are recessions. What you'll notice is that we are at places on the unemployed, on the people who say they were fired, on temporary workers declining. We're at levels that this black line only gets touched on the way into or already in a recession. See that here, right here? See right here, right here? Same thing down here, here. Tapped it, came back away, tapped it, broke above, that was a recession. Now these levels aren't gospel, this is just where we are now. And we're in recessionary levels on all of these kind of internal components to the labor market. So this is happening while the growth of jobs over here has fallen back down to its regular, normal rate of change. So if job growth is no longer strong as it was before, and if these other measures here are actually touching levels that only get touched in recessions, then I got to think we're getting really close to that period where it becomes more obvious, like sometime in the next 4 to 6 months. It feels like it's taking forever, right? It feels like that this has gone on a lot longer than it should have. But as we've looked at together on here, right, we're actually kind of on track, right? This black line is non-farm payrolls since the yield curve inverted. And this gray line is all the other recessions from when the yield curve inverted. And you can see we're still climbing, but it takes 12, 13, 14, 15 months for labor to start rolling over on average compared to when the yield curve inverted. And we're not even to the year point yet. We will by the end of this month. If we look at this, let me see if we can, where's the one that shows all of them? Here. This is job growth from all the prior recessions. And you can see us in this black line here in the middle, right? And you can see these were all recessions. See where all these recessions hit? They're all out in front of us. They're either right where we are or they're out in front of us. And in all these instances, labor continued climbing and then it rolled over months later, right? Another 6 months from now. That's Q1 of next year. That's February, March, April of next year, if we follow these other past eras. So there's still room out ahead of us. We're still inside the window of when shit goes awry. That's why I've remained on alert. That's why I've remained with my bearish tilt. Because the data strongly supports that. And it will until we get out over in here and jobs are still holding up and the economy is still holding up. And we can say, well, we've never had a recession after this much time's gone by. Are we still going to? Then we have to start really asking hard questions. But right now, things are kind of playing out to a very familiar song. Thoughts on yield curve uninverting as an early sign recession is imminent. It does happen often that the recession or that the yield curve uninverts before the recession hits, but not always. The yield curve inverting in the first place is the most reliable of the signals. The uninversion is a product of a couple of different things. It has to do with how quickly the Fed responds, how much they cut rates, what the long end is doing at that time. So The yield curve uninverting does tend to happen. It's something that happens right around the beginning of the recession a lot of the time, but not always. So I don't tend to focus on that piece as much. But we do see the yield curve uninverting, right? We do see that that's happening. A lot of people are looking at it. Where is it? Here we go. Here's the yield curve. You can see that it's uninverting. Oops. Where's 0 on this chart? Here it is. So the yield curve has been steepening since May, but this part of the steepener right here, this has not been because the front end has been falling because the Fed's cutting rates. That's what often makes the yield curve steepen. This has been happening because the long end is rising. That is a bear steepener rather than a bull steepener, and that is why risk assets are eating shit right now. So I do still think we're headed for a recession. I think if we get one, Bitcoin's going to go down lower. Don't know how long it'll be. But we're at the top of a 15-year expansion after a lost decade. Right? So are we in for another one of those? Is this the next few years? You have to be open to that, or open to something else, right? Everyone just assumes that we're just going to keep going up, 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 up. That it just does this forever, but that's not actually how the market has ever worked. It's always gone through these long periods of consolidation. Right? Look at this. And then it gets like 15, 20 years of up, and then it goes sideways for like 10, 15 years, 20 years. Then it goes 15, 20 years up, and then it goes 10, 15 years sideways. And it goes 15, 20 years up, and then 10, 15 years sideways. Like, I'm not suggesting something crazy here. This is how the market works. So you just have to be open to, maybe we're about to have one of those. Maybe it's worse. Maybe it doesn't stay in that box, you know? Maybe the box is a lot bigger. We just don't know, guys. And I contend that this is, being in this kind of a box and it being a lot deeper than we think is far more likely than this, which is what most people seem to think we're going to do. Sometime in the next few months they'll cut and then risk assets will moon. Everyone thinks that. But I don't think that. And one of the reasons that one of the last charts I'll show you guys. Let me find this chart actually. I'm going to find it on my Twitter. From TXMC Trays, backstop depression. I got to find this tweet. Here it is. Okay. See, one of the reasons why I think we're getting to a risky place where we might have something worse than a recession is because, see, a lot of people think that the 2008 recession was the end of a long-term cycle of debt. But I don't actually think that it was. I think that it was just the biggest can kick moment that we've ever had because we didn't actually deleverage at a societal level. This is the levels of debt during the Great Financial Crisis in 4 sectors. Blue is the public debt, the government, the public sector. Purple are financials, so the banks, shadow banks. Green are households, and red is just corporate businesses. And what you'll notice is, yes, there was a major deleveraging in financials, right? A bunch of banks went under. Also some household deleveraging. But all of that debt was transferred to the public purse. You see that? When the daisy chain teetered, the Fed swung in because that was going to be a depression. If they didn't backstop it, we were going into a depression. And rather than allow a full-on deleveraging to take place, because who knows what the consequences would be, they just transferred all those promises to another lender. You and me, the taxpayer. That's who became the new lender. And all of that bad debt from which the bankers had already profited was transferred to the public purse. The people always pay. And we just kicked the can again. But now we're at a place where the public balance sheet is significantly worse than it was in 2009. Yes, households are not as levered as they were. Financials aren't levered in the same way, but they're holding a lot of unrealized losses in treasuries because of the reversal in yields. But the public sector, the public balance sheet, not just in the US, but around the world, is significantly worse than it was in 2008 and 2009 by 30, 40, 50% of GDP in some cases. And so I think we're actually really dangerously close to triggering an actual global deleveraging event where you can't just absorb the losses onto someone's balance sheet. And if that's the case, that would jive with, something worse in equities that wasn't just a bounce and coming out or just, hanging out in a box the way we hung out in a box here. Sorry, here. So I know I'm kind of rambling a little bit, but it's hard to know as well, right? Because we're trying to predict like the unpredictable. And whenever you talk about this stuff, people assume you're like, oh, you're saying it's just going to be this again. It's just going to go straight down 90%. I don't know that. But I do know what I just said, which is sovereign balance sheets are way worse. There's significantly more debt than there was before. Fiscal space is limited because of the size of the deficits, and those deficits are being eaten up by non-discretionary spending, right, by entitlements and interest expense. And so there is just less policy space to rescue the economy. We're also at a place where demographics are fundamentally different, right? Especially from the 70s, but also different from this period here, because it wasn't until here that the boomers began retiring, the largest generation in history. They were still working throughout this period of time. Well, they began retiring here. And by the time we reached 2015, which is right around here, by the time we got to this point, retirement was the number one drag on labor participation for the US. It was the number one reason people weren't getting jobs, is because they were retiring. Because we are getting older, we have this massive generation of people who didn't have as many kids as their parents did. They didn't have enough kids for replacement rate. Then the millennials, they themselves also had even fewer children. And so the population isn't growing as strongly at the same time that debt is continuing to balloon, and we're running out of places to store the debt, right? There's only so many balance sheets in the world that can absorb the spending that is expected to come out of these governments. And a lot of people think that we're just going to do a Weimar thing and they'll just absorb all of it on the balance sheet. And, the Fed balance sheet's going to do this, and risk assets are going to do this, and Bitcoin's going to do this, and gold's going to do this. Like Weimar Germany. But I contend that it won't be that graceful, and that there will be institutional resistance to doing those things for political reasons, for practical reasons, for a number of reasons. And that we're not just going to get one of these, and that we're probably going to get something, a lot more like this. And it might entail, that's not what I meant. It might entail like a deep drawdown, something that takes out the COVID lows. I don't know. But interesting times we live in. Tell us one thing if you can, when moon. Well, I'm going to wrap up here, friends. I went a little longer. I went an hour and a half. I said I wouldn't. But last time was like an hour and 45 minutes. So if we can stop here in the next 5 minutes, then I'll still have done a shorter stream. I was about to end at an hour, but someone asked me a question and then I talked for 20 more minutes. You know how I do. So make sure that you follow me on Twitter at TX or MC Trades. Make sure you follow me on YouTube on the channel you're watching right now. Please subscribe to my channel. We're at 19,000 subs. If I can get to 20,000, that'll be amazing. That'll be amazing. We're almost there. And, we'll just keep chugging along. I appreciate you guys hanging out here. These live streams are kind of free form. We don't have like a set structure to them. I never really know what we're going to talk about until just before we get on the stream. So, yeah, I appreciate you guys being here. I really do. Thank you so much. Can I elaborate on my view of why there won't be a V-shaped recovery after a potential recession? Well, there might be a V. It's just, where is it? Like, there was a V at the end of the great financial crisis. But where was the V bottom? Equities were down 53% from the V bottom. So, does it matter? What the bottom looks like doesn't matter. It's how big is the red box. So, don't get caught up too much in the V bottom thing. People think we're going to get another one of these COVID moves like this. I doubt that. So we'll see. But also, just remember what the COVID move was. 35% in 1 month on the S&P. That's what it took. And the Fed actually pivoted twice. They pivoted right here, and then they came in again with even more right here. It took twice them doing it. So that's it. We're going to stop. Make sure you smash the like button if you haven't. We will do another one of these 2 weeks from now on a Wednesday or a Thursday, week after next. I don't think I'm ready to do these weekly, but it is something we'll probably get to at some point. Maybe we need to break them up. Do like Bitcoin on chain for one, do macro for another one. I'm not real sure because macro doesn't move that fast for us to talk about it every 3, 4, 5 days. I want to have something fresh to talk about each time if I can. So I'll think about that some more, but definitely 2 weeks from now at the latest. So thank you, everyone. Hope you have a great day. Until the next time we meet, take care of yourselves. Take care of each other. Call your family. Talk to them. If you are like me and you think there is a possibility of a recession in the next year, just talk to your fam about it. See if they've been thinking about it. Make sure they're not gig along with all their money in the stock market. Just kind of talk through, okay, what would it look like? What do I need to do to be more protected? Do I need to have some of my money earning 4 or 5%? If it's just sitting around in the bank, I think you should. Some amount of it. Just talk about that stuff with your family and just be prepared. That's all. Just be prepared. We'll see how it goes. Thanks, everyone. Love you guys. We'll talk again soon.